Let's move into our wrap the week segment. I want to start with a poll. Actually, we asked you in a couple different places, and we ran this poll on StockCharts TV as well as some other venues as well. Which asset class does best over the next 3 months? And I gave you the choice of rocks, scissors, and paper. And basically, the idea of that came from an exercise we would do as a team at Fidelity when I ran the group there. We'd always talk about rocks versus paper and think about hard assets versus soft assets and what that means. So I've added scissors, which is basically, think of clipping coupons on a bond certificate, and that tells you why bonds are these scissors form. The results are in split almost perfectly between rocks in the form of gold and paper in the form of the S&P 500 in the form of stocks. So about 45% of you answered both of those. A lonely 9% offered the answer of bonds, which is interesting to me. We're going to talk about, if you look at the returns over the last year, the two of these that stand out up over 20% over the last year, gold and bonds. The S&P is up maybe 7-8% over the last year since July of 2019. So it's interesting if you look back over the last 12 months, gold and bonds have actually been number one and number two. But having said that, I think you've picked up on what the charts certainly seem to be validating. The chart of gold, we heard from Jim Smith earlier this week. We've looked at it a number of times. Certainly building momentum and trading to new highs. Stocks, I think, are in sort of wait and see mode. If I had to answer that question, I would probably say rocks. I would answer gold, although bonds might be second for me. So I'm certainly not as optimistic as many of you are, and I have been wrong before, and it won't be the last time. Let's look at some of the charts together. Let's think about how we can answer some of those questions together, thinking about the setups that we're seeing. In terms of what happened today, if you look at the little preview chart, we gapped up, and to be honest with you, a holiday weekend, especially the day before a long weekend, usually is met by lighter volume, which has been the case this week. It's met by sort of flat to higher prices, which is what we've seen. So this is not much of a surprise, sort of what you'd expect with this sort of week. And I think, to be honest, it sets the stage for next week, which is everyone coming back. This was quarter end. This is a lot of weird things happening this week. Next week, we're sort of, quote unquote, getting back to normal. We'll see what sort of follow through we would get. The way that we ended the week was in a period of weakness, and the last hour going into this holiday weekend was met by selling. So the S&P was up above 3150 about an hour and a half ago, and it closed actually up just under 0.5% to 3130. So still an up day, but again, I love to look at that first 30 minutes, the last hour, and just see what sort of indications you can get. And we sort of are heading into the long weekend in a stretch of weakness. Mid caps and small caps actually right about in line. They're all finished up about 0.5%. The VIX is back below 28 now. Looking at other asset classes, we asked about bonds. Bonds actually finished just above flat for the day. They really chopped around. They opened up pretty low and then sort of came back up and traded around the zero level. That's about where they finished off. Yields down a little bit today. On the commodity side, gold finished just a little bit higher. Actually gapped down, but moved higher through the course of the first hour of trading and remained relatively strong. So commodities as a whole, stronger rather than weaker, although it was a mixed bag with silver lower and gold stronger today. And again, I've thought a lot about Jim Smith's comments, super bullish on precious metals. So it's interesting to see how the charts evolve relative to what he had talked about. Now let's get into some of the details wrapping the week. In terms of other quick movements, I don't have a lot I think I need to update you on, just because in general, the way that I would always think about this on the institutional side, you don't want to draw a ton of conclusions from a shortened holiday week just because the volumes are light. So any movements that you would see are more kind of, less meaningful. They're more just sort of getting things lined up, keeping things going until we get back for real on Monday. So let's focus on some of the long-term trends and how they've evolved. And what we're going to do is focus on the Mindful Investor Live chart list. I don't give myself enough time to get through all of this, so I'm going to try to do a little better today, and we'll see what we can come up with. So we're going to start with what I call the market trend model, and again, it's something I've developed over years, and a number of people use some form similar to this to understand the long-term trends. And if you followed what we talk about on the show here, I think you can see my goal is not to follow a model like a robot and just systematically do it. That's certainly not my style, but I also see the value in having some discipline behind what you're doing. And so for me, models are an input to my process. They're not an output of it. Meaning I like having models running in the background. I like running screens in the background. I like looking at the results and going through them and evaluating them as a strategist, as an analyst. But in the end, I want to make the call based on the weight of the evidence that I see. And the models are part of that. It's a key input into that. So, overall, as I see signs of weakness, as I'm sure can pick up on the language that I'm looking at, noticing divergences, noticing weakening breadth, I have to acknowledge the fact that the trend has been positive. And when you look at the weekly chart, you don't see short-term consolidation. I mean, you see short-term consolidation, but I mean, the long-term trend certainly appears to remain positive. Higher highs, higher lows. If you look at the swing highs and lows, those continue to ratchet higher. So this last couple weeks, this last month certainly just feels like a healthy pullback within the context of an uptrend. And so that's when the model is telling you long-term bullish. I think that feels about right. I get why it's saying that, and I can live with that. On the medium term chart, it's also bullish, and that's based on the weekly PPO or the weekly MACD. That turned positive sort of beginning of May, and that was after really the market had rallied significantly. Remember when we were facing right around this point, we sort of had that next sort of push higher, and then we broke above 290 up to 300 on the spiders, and approaching 3,000 on the S&P 500. Certainly validated follow through to the upside, and I think that's where we're at. The short-term signal has sort of jumped around. Technically what I do is I look at the difference between these two moving averages, and I just consider that a short-term signal. To be honest with you, the real short-term read I use is looking at the daily chart day to day, which is what we'll go at next. But based on this as a system, short-term back to bullish because we're higher than we were last week. So these moving averages are spreading out. So the market trend model that I follow is short-term, medium-term, long-term, all bullish, and that makes sense. I get it. And for me, the question now is, what signals can I start to uncover that would indicate to me some potential weakness, right? If everything is going great and I'm happy being long or assuming further uptrends, what would indicate to me a reversal of that or an exhaustion of that uptrend? So let's go to the daily chart second. Today was interesting. And again, I'd hesitate to draw too many dramatic conclusions based on today because it's a lighter day, lighter volume, less participants, less of a pure read on supply and demand. It's more just an indication of limited conclusion. But I have to acknowledge the fact that we traded above 3150, which we've talked about as being a key resistance level from the middle of June, right? We sort of, it was the first rebound after the big gap down second week in June. We sort of hit 3150, bounced off of it 3 out of 6 sessions, and then pulled back. We're now right back up to that level. And earlier today, it felt like, this is actually going to follow through to the upside. So I'm starting to think, is that going to be enough? Are we going to have enough volume to make that feel like that's a follow through? And what's interesting is we actually finished back toward the lows, which in some way further validates that 3150 level as resistance. So what we've talked about is in the short term, we're sort of bouncing between 3,000 and 3150. If you widen that out to, I think what the key trigger would be, it would be 3,200 on the upside, which would be, sort of here, maybe 3,230, which would be the peak from the first week in June. On the low side, you have around 2,960, 2,970. That's the low from the second week in June. We're right in that range. And I think we've established this short-term range as being pretty important. We're between 3,000 and 3,150. And until we break out in a meaningful way from one side or the other, I think you have to decide overall that the short-term trend remains sideways. The fact that on that market trend model, it's flipped every week from bullish to bearish sort of confirms what I think we've seen here, which is we're range bound, and that's fine. It's an interesting thing. I've had plenty of questions on this model. I've threatened to write more of a blog post, which at some point I will certainly get around to doing. But, one of the things I thought about as I first created and sort of started using this more and more is I basically have a binary output. It's either bullish or bearish. I don't have a neutral version. If I did, it probably would be reading neutral on a couple of those for sure. Breadth is an interesting one. Earlier this week, this started to look a little more negative. And we've bounced off a little bit. Overall, I still think that the pattern is leaning more bearish because we've made lower highs and we've technically made a lower low. And until we make a higher high and sort of invalidate what we saw there, I think I have to assume that breadth on the NYSE, on the mid caps and the small caps has tilted short-term negative. It noticeably did not do that on the broad S&P 500. So here you actually have a pure consolidation, lower highs, higher lows, exactly like the chart of the S&P. And again, in general, this cumulative advanced decline line is going to break one way or the other. I would not be surprised if the direction we break from here really gives us a lot more information about what to expect over the coming month or two, because I think that'll indicate, now that we're in a consolidation phase, give us a signal that we're breaking out. And I think that's what I would be looking for. I haven't seen it yet. In terms of new highs, new lows, this has been pretty limited. And again, it's just, if you look at where the S&P is relative to its high and its low for the last 52 weeks, we're pretty far away from both of those. And I think for most stocks, that's kind of where we're at too. There are a handful of names that are making new highs, and it's the things that would be like at the top of the scooter rankings, stocks like Tesla and Amazon, Netflix, these sorts of names that have gone to new highs and have established new 52-week highs. But again, it's a very small number relative to what has normally happened in a bullish phase or in a bearish phase. You'll get an exaggerated number of new highs and new lows. It's been very muted since March for understandable reasons. One measure of breadth we've looked at a lot is where what percent of stocks are above their 50 and their 200-day. On the bearish side of the ledger, if I'm listing out all of the evidence that I can see, the fact that less than half of S&P names are above their 200 days certainly, is an area for concern. And the number's even lower if you look at the New York Stock Exchange, if I believe it is true. The S&P 500 is back above its 200-day, but less than half of stocks are also doing that. And so that tells me that it's less names, big cap names, that are driving the index higher. That's just how the math is going to work on that. It's interesting to see that we actually, for a bit over the last day or two, had less than 50% of stocks above their 50-day moving average. That actually bounced back up yesterday to just below 70%. I'm not sure how things are going to end today, just because it was, we don't have that value locked in yet. But I'll be looking at that for sure over the weekend to see where that nets out. But in terms of a long-term read, I feel better as a bull if over 50% of the S&P was above its 200-day, and we haven't seen it yet. Sentiment, as we've talked about, I use sentiment as an anecdotal piece of evidence. I would never trade off of an indication like the AAII rankings or, the Ridex flows or something like that. But I always find it very interesting, just like I would find, some huge investment theme on a magazine cover. I think it's really compelling, and hopefully it leads you to start digging deeper as to why the results are a certain thing. Why is an investment theme featured on, Time magazine, for example, is one of the things we would always do here. So again, it's not a system for me. It's anecdotal evidence, but I think it's important because it shows you, with readings that we can get, what are people voting bullish or bearish. And it's actually been a narrowing of sorts. You have less bulls and you have less bears. Overall, it's still about 2-to-1 favoring bears over bulls. So don't get me wrong. On net, it's a bearish read, and you can see that from the gap between the two. That turned negative late February and is not turned back to the positive side. But I thought it was interesting, just incrementally, you're seeing less and less conviction on the side of the bulls and on the side of the bears, and that's about how things are netting out. We only have time for maybe one more chart, and the last one I have to show you too. I'm so sorry. Number one, we've looked at small caps outperformance since the March lows, and that's, if you look at the long-term chart, this is a huge downtrend since 2014, probably, showing small cap underperformance. But what's happened since March, small caps have actually been outperforming. What's interesting is if you take a trend line using the lows, this is not a beautifully drawn trend line. We haven't broken it quite yet. This is more of a quick sort of pencil drawing of the uptrend. But we're at the lower end of this channel. If you consider this a channel coming from the lows, we're dangerously close to starting to break down through that trend line, which would indicate to me rotating back away from small caps. And the last chart I'll leave you with is the outperformance of growth. I again have heard so many times the return of value starting to work. The ratio of growth to value still very clearly favoring growth. I haven't seen that change materially yet. So it's still telling you to lean into the growth trade away from value as you can. We'll take a quick commercial break, folks, and we'll be back with our final bar mailbag. We'll see you in a minute.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.